the fire burning of real estate was always there, and the flame never really went out. And I don't know. I just woke up one day in 2011 and was like, I got to get back here and start buying some opportunities. Everyone knows the old adage of you buy low, sell high. You buy when there's blood in the streets. And I'm like, I'm an idiot. What am I doing here? Like, why am I sticking my head in the sand? Why am I trying to avoid what is now probably some of the greatest opportunities that have ever existed?
You're listening to Investing for Good, a show that brings you the stories and strategies of people who are investing to build a legacy for their families, create a meaningful and intentional life by design, and impact the world around them. And now, here are your hosts, Annie Dickerson and Julie Lamb.
Hey, Julie, how's it going?
Hey, I'm doing good, Annie. How are you?
You know, the world sure has changed a lot in the last few weeks. Man, your kids are home. My kids are home. Mm-hmm. You've learned to cut hair. We've learned lots of things. We've been doing lots of things that we hadn't previously been doing. But how are your kids today?
Yeah, they're doing good. You know, we're rolling into our fourth week this week of homeschooling and the kids being home. And this has officially now become our new normal, you know, and just like anything else, just like I always think about when you have a baby, it's like, oh my gosh, like this is so crazy. How do they expect me to care for this thing? I don't even know what I'm doing. Like, this is crazy. And that's how it was like the first week. I was like, this is just crazy. Like, I don't know what they're, you know, these teachers, blah, 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 blah. And it was just crazy. So, but now, you know, by the fourth week, we have our routines and, figuring out the grocery shopping has been a bigger task than I thought it was going to be, and trying to secure delivery windows and playing that game. So it's been interesting. So, yeah.
Yeah. Who knew that getting a simple grocery delivery would turn into this whole thing?
Yeah. It's been crazy though, because I still remember when we were on our way to Tennessee back in January, and Kevin, on our show today talks about this. And I remember back then, I don't pay attention to this kind of stuff usually either. And I just remember back then watching what was happening out there and just knowing that it was just a matter of time before it was here and before we were living like they were. And sure enough, here we are. And it's crazy. But, you know, it's funny in a weird kind of a way. These are days that I feel like I'm really going to miss because my family and I have been so close, and we eat 3 meals a day together, 7 days a week. And, we've learned to adapt and get along in a way that we hadn't ever before. And we're just spending so much time. We have family rituals now that we just didn't have the time for. And so in a weird way, I'm actually going to be kind of sad when all of this kind of comes to an end and the kids go back to school and husband goes back to work and we go back to doing our stuff. And so, yeah.
Yeah, I feel exactly the same way. It's, there's pros and cons, of course, but yeah, someday I think we're going to look back on this time and remember it fondly. You know, when all the tantrums and stuff have faded away from our memories, we'll remember all of the good times from this time.
Yeah.
But anyway, let's get into today's episode. Today we have on a very special guest, Kevin Bupp. He is the founder of Sunrise Capital Investors, and he invests predominantly in mobile home parks, which is a fascinating asset class, especially because they always say that mobile home parks are recession resistant.
Right. Yes. And it's something that we have dabbled in a little bit, in over the last couple of years in preparation for today and this time that we're in now. And we always said that was coming soon. So it was really interesting. I think perfect timing to have Kevin on the show to talk to the audience about why mobile home parks, and especially why now is a good time. And he gave us his sort of top 3 tips for investors on, why mobile home park investing is recession resistant. And so, those top three things being supply and demand issues, as well as he mentioned something about in some instances where they're owning just the lots and they don't actually own the actual home. And so in some instances, when people lose their jobs or lose their inability to pay, they would sell those. But in the meantime, while they're looking to sell those, they're still able to collect lot rents, which is different, obviously, than multifamily and what we do. And then the last thing that he had mentioned was around, a lot of the inefficiencies that are available to these two buyers like him and his partners in the way of a lot of people who own these mobile home parks are the mom and pop operators. So, there's a lot of opportunity there that I guess may not be there with, multifamily and what we do. So, yeah, it was such a great episode. Kevin has been, investing for the last 16 years. So, I know a lot of people are always looking for people who have been doing this for a really long time. And Kevin is definitely one of those people and has loads of information to share with everyone. So,
yeah, and he goes into depth about all that happened with his portfolio back in the last recession, which was brutal. So, my goodness.
Yeah, that was painful.
All right. Without further ado, here is our conversation with Kevin Bupp. Kevin, how are you?
I'm doing great, Annie. How about yourself? And Julie, pleasure to meet you as well. Thanks for having me here.
Of course. Now, Kevin, you invest predominantly in mobile home parks, which is not exactly the first thing that most people think about when they think about real estate investing. But I have heard that mobile home parks tend to be pretty recession resistant, which is incredibly relevant right now, given where we are in the midst of this COVID-19 pandemic as we record this, and on the precipice of a potential recession. So let's start with your story, and then we'll dig into your outlook and your perspectives on this crisis, as well as your current investment strategy.
Sure.
So start by telling us maybe how you got started in investing in real estate and how you found your way to mobile home parks, of all things.
No, it's a great question. I'll try to keep this short, but I'm 40 years old now, and I got started 21 years ago. I was 19. I always like to say that real estate kind of found me. I didn't find it. And so I feel very blessed and grateful for that. I was just going to college and not really knowing what I wanted to do with my life other than just, get those 4 years out of the way and then figure it out after that. And ultimately, a gentleman by the name of David introduced me to this business. He was a local landlord. I met him through a girl I was dating at the time. And he was about 25 years older than I. And he owned a bunch of single family and small multifamily properties and lived a pretty cool lifestyle, very different than my upbringing. And this seemed to have a lot of flexibility in his day and seemed to have not many cares in the world, just based on my perception of how he kind of carried himself. And ultimately, we grew a pretty tight friendship over the first couple of months of me meeting him. And he essentially invited me to a 3-day boot camp that him and his partner were supposed to attend down in Philadelphia. And his partner couldn't go. So he said, "Hey, you want to come? I'm not sure what your plans are after school, but, if you have an interest in what I do, this would, be a good introduction to it." And so I went. I had no idea what I was getting myself into, but I figured he had spent about $3,000 on these tickets and that I might as well take advantage of it and go see if I could learn something that could benefit me, in years ahead. And ultimately I was intrigued, overwhelmed, had a lot of emotions rolling through my body. But, when I left that 3-day event, I ultimately said, I met a lot of people there during those 3 days that I didn't feel were any smarter than I. They knew a lot more than I did about the business, but I didn't feel like they were any more intelligent than I was and that they were doing very, very big things. And that was exciting to me. And so ultimately I came back and said, "David, how can I help with your business? Like, I don't know where to get started here. I'm overwhelmed. I'm excited, but I don't know where to go from this point forward. How can I help you with your business? Is there things I can do so that I can not just be around you like on a friendship level, but like be around you when you're, transacting your deals or talking to residents or talking to contractors. I just want to be around to absorb all this information." So ultimately I became, I didn't really have a title, but call me his executive assistant for a period of about a year, where in between tending bar in the evenings and going to the school, I was at his home office out in the field. I was wherever he needed me to be doing, whatever he needed me to do, even if I was going to pick up like coffee at the store, right? I'd just be there for him to help him out. And ultimately I learned a ton. I got introduced to all of his, his personal relationships with private lenders, got to see, just how the process started from A to Z, as far as working with contractors, doing rehabs, working with tenants, signing leases, evictions, what have you. And so I bought my first property when I was 20 years old, utilizing a lot of the connections that David had helped me with, and some of the savings I had from tending bar. And that was the start of it. So fast forward to about 8 years moving forward, built up quite a large portfolio of single family properties and multifamily properties, as well as some other commercial real estate, and lost it all in 2008. And then ultimately was introduced to mobile home parks in about 2011, as I was working to rebuild myself from the catastrophe that had occurred in the years prior. Again, by accident, I came across mobile home parks just through a mutual friend who I ultimately went and had a lunch with, just to talk business and to, enjoy the day. And I never knew he owned mobile home parks. Found out that he owned 3 of them. It was doing quite well, and basically sold me on all the reasons why I need to put some energy into learning about that niche and why there was a lot of opportunity there. And so that was back in 2011. I bought my first park in 2012 to either prove him wrong or prove him right, and ended up proving him right, and bought another one a year after, and then a couple more the following year, and ultimately formed our company about 4 years ago, Sunrise Capital Investors. Now we syndicate mobile home parks across the country. We own parks in 13 different states today, and that's been the core of our business. So that's like the condensed version of my background.
Wow. So it all started with you sort of noticing that this guy was, seemed to have a pretty good life, a life that you wanted. And then you went off and then you tried to emulate what he was doing and figure out what he was doing so that you could have that life yourself.
That's it. I mean, I grew up in a blue collar family. I never went without. We weren't poor. We didn't have a lot, but we didn't have a little. We were right in the middle. We went on one family vacation a year that my parents saved up for all year long. And, it just, we had everything we needed. It was, to me, we lived a normal life. And, we surrounded ourselves with folks in our neighborhood that lived similar lifestyles. So I just didn't really know any different until I met David, and just opened my eyes to just really a different world, a different way of thinking about, why am I going to school? My parents went to school to go get a job afterwards and worked the same career for 35, 40 years. Not all that happy with what they were doing, but they knew they had to do it and get to retirement age. And that way they had some income streams thereafter, and then they could go enjoy life, right? Like that's how I was raised. And David lived a life very different than that, which I thought was pretty cool.
So what did your parents think when you were 20 years old? Most people at 20 years old are not buying properties. You're 20 years old, you're attending bar, you're going to school, and you buy your first property. Was your family like, "Ooh, Kevin's crazy"? Or were they like, "Wow, Kevin's like figuring it out"?
No, they thought I was absolutely crazy. And they actually thought I was crazy even when I was just hanging out with David. You got to remember, David was about their age. And so I'm hanging out with this guy, this guy that basically is my parents' age. And like, they're wondering, why does this guy want to hang out with this 20-year-old? Like, they just have these weird, creepy thoughts going through their head of like, what's going on here? And so initially they were kind of weirded out about that when they realized that, that I was excited about learning something new. Like they were appreciative of that, but they also didn't, even to today, like they still don't understand the world that I live in, the world that we built with my business and why I do what I do. I don't think they really grasp that mindset. And so they thought I was absolutely insane. I had $7,000 in my name that I had saved up, tending bar, making tips every evening. And I used literally every penny of that to buy that first property along with some private money. And they thought that was the dumbest decision that they've ever heard of. And I bought it in a part of town. Everyone lives inside this bubble, and it's hard to actually get outside that bubble and see it from a different perspective. So they were born and raised in this town I grew up in, and as was I. But they've seen, over decades, they've seen areas change, get from bad to good to bad. And I bought in the part of town that they always basically, if we drove through that part of town, they locked our doors. Like we locked our doors. They're like, you keep the doors locked until we get to this point, And so they thought I was also crazy because I bought in, what they deemed to be a neighborhood that like, you're going to get shot. And, it wasn't the greatest neighborhood, but it was like a transitional neighborhood. And there's like, you're an idiot. What are you doing? But anyway, it turned out well.
I think it's really hard for the older generations to really, identify with what we're doing because it was so
Yeah.
ingrained in them that this is what you do is you go to school and you work a job for 30, 40 years and then you live your life when you're in your 60s. And that's the struggle that I think Annie and I face on a daily basis, even with people who are our age, because
Mhm.
they're so trained to really think that the path to freedom and the path to happiness is to work, a job and stay there for 30 years and then retire at the end. So I think that
Mhm.
that's a tough hurdle for a lot of people to overcome.
Yeah, no, I agree. And I think the one saving grace for me is growing up, I just academically, I never enjoyed school. I'm very different today. Like I'm the complete opposite. I love learning. I love education. I just didn't love I didn't really understand, traditional education in comparison to, learning about what it is you enjoy learning about. And there's many different structures now. We understand that everyone has different learning abilities and they receive things in different ways. Back then, we didn't understand that everyone got taught
Right.
the same exact way. I
Right.
hated school. Like I just
Yeah.
didn't enjoy it. I did it because I had to. And so
Yeah.
I think I've always been like one that's kind of pushed against the grain, that's always going a slight different direction than everyone else, either my family or friends that I had. And that to me, like that was, I didn't know anyone else other than David that was doing that. And to me, like that was exciting because it was very different than what everyone else was doing. Because I was not excited about going the route my parents went. I just didn't
Right.
know any different. And
Right.
so,
Which I think is true for so many of us real estate investors. I know it was definitely true for me, who I am today. Certainly not the same person I was 20 years ago, academically speaking, and the interest in learning and all of that stuff. But real
yeah.
estate opened so many doors, and it's been such a fun journey so far. So one thing that you talked about that given everything that's going on, that I really want to dig into is you said that in 2008 you lost it all. So I'm just
Mhm.
curious, what did that mean? What led to that? What mistakes did you make? And how did you, in 2011 when you were rebuilding everything, how did you reposition yourself and recreate yourself to be able to, sustain everything that we're going through today?
Yeah, no, that's a great question. Looking back at 2008 and in the years prior of like building up to that, I got really good at the small model David had taught me, buying single family properties and turning them into rental units. I moved from Pennsylvania to Florida in 2002. So I stayed in Pennsylvania investing for a couple of years. And then I moved down to Florida. And that's when I really ramped things up. And looking back, there was a lot of inefficiencies that began to build in my business, and mostly in the single family side of our business. And that, was a result of owning properties in multiple different counties, hundreds of properties in multiple different counties, inefficiencies with the management side, the repairs and maintenance side. In addition to that, I always called myself a cash flow investor back then. And I really don't think I fully understood or was being honest with myself as to, were these properties, not just individually as a portfolio as well, were they truly sustainable cash flowing assets? Forget about
Right.
what the equity looks like on paper, right? Because
Hmm.
this is back in the run up prior to 2008, Florida. I mean, like values were just going insane. We were seeing double digit appreciations every year for many years straight. And across the board, we looked at like our leverage point. We had very low leverage. We were buying with the margin of safety. And again, we were producing cash flow, but not sustainably across the entirety of the portfolio. And so ultimately what occurred is it was like there was multiple nails that got put in the coffin. A couple of the big factors were just a lot of speculative builders down here in Southwest Florida back in that day. Very different times back then than here now. There was thousands of rooftops that were being built for populations that weren't necessarily coming. And so the first thing where we had a big blip in our business model was, as soon as these builders stopped selling these new houses that were built, they basically knew they weren't going to be able to get rid of them. They had loans to service. And so they essentially started renting these new homes out, all this inventory out. And a lot of the markets where we owned a lot of older inventory, homes that were 20, 25 years old, what have you. And so within a period of 8 months, we had a pretty significant non-renewal rate or exodus rate. I call it the exodus rate, as far as people moving out and new people not moving back in, because there was a ton of supply on that market, just an oversupply. And it was all new. And they were leasing it for not much more than what we were leasing these older homes for. So number one, our vacancy rate skyrocketed pretty quickly. Number two, within a period of 8 months, most of our properties were upside down. I mean, Florida got just smashed. I mean, so basically all that, all the equity that we had on paper that we were always excited about and touting basically evaporated very, very quickly. And then all the other inefficiencies that we already knew existed started really heavily weighing on our business. All the repairs and maintenance, the inefficiencies there, the inefficiencies of owning, properties in multiple counties with the management side of the business. And then to really tie it all together, we had a lot of cross-collateralized properties. What we would typically do on the single family side of our business, because we had single family and then we had multifamily. Multifamily was a very passive business for us, but the single family was like our core. We would basically go buy, 8 to 10 properties with private money, and then ultimately go get a cross-collateralized loan from a couple local commercial banks that we had relationships with, and then put one line on all 8 or 10 or what have you, those little tranches, little packages of the properties. And so whenever we had an issue with 1, 2, or 3 of those properties, ultimately all 10 of them started having issues. And this was also the point in time back then. There was no such thing as a loss mitigation department in banks. It just like that department did not exist until 2008 occurred, and so we started feeling the pain very quickly back then. However, banks weren't feeling it yet. They weren't feeling it to the point to where they were ready to do workouts or loan restructuring and what have you. Like today, I think we're much more aware of that. Although, the agency loans, I know they've already offered like loan deferrals and forbearance, what have you. The other lenders have not yet, but I think that they will get there much quicker than they probably did in 2008. There won't be as much of a delay there. And so anyway, it was just this was a snowball effect that we experienced. But back to the original point of what we've changed with our business today is we're much more honest with ourselves as far as the sustainability of our assets. And are they really cash flowing assets? Forget about the appreciation. The appreciation is great. It's icing on the cake. It also can evaporate fairly quickly. Cap rates go up. That appreciation is gone, right? But can they sustain through a downturn? And what does that cash flow model look like? Can they sustain for ourselves, for our investors, and everyone else is involved in that deal? Can they make it through a downturn without completely becoming irrelevant investments? And so anyway, those are some of the big factors that really hurt us. And so to tie it all together, we also owned multifamily investments back then. And it was interesting. That was never a core of our business. We ended up just buying. We had about 500 units, 40 units, 60 units, smaller buildings. We never put a lot of emphasis on buying those. They were brought to us by brokers. We bought them. I'm not going to say we didn't know what we were doing. That business kind of ran itself. We should have just switched our emphasis and actually started focusing on the multifamily stuff, because those did fairly well. They all got affected during the downturn. And we had more vacancies than normal, what have you. But the only reason that we ultimately had to essentially exit out of those is we had a lot of short-term commercial debt back then, 5-year terms, 20-year amortizations. Debt was coming due in a couple of years. And by that point in time, our credit was challenged. Our liquidity was basically next to nothing. And we couldn't, and there really wasn't new debt available in 2009, 2010. It didn't exist. And so our entire business from 2008 to 2010, we essentially, lost about 1,000 properties in total, and had to either get back to the bank or short sale or fire sale. Many different things that we went through there. But in any event, I just rambled on there. I don't know if I really answered your original question as to, what were the challenges that we really faced with that business and how's it changed today. But I hope I at least gave some insight to that.
No, yeah, that was really great. I mean, I think that's a lesson that's well learned in terms of looking at cash flow. And it's certainly something that we talk about all the time when we talk with our investors in terms of, people are always asking, well, what should I be looking for? And I think since Annie and I got into this, it's always been that the recession is coming tomorrow, because we had already, gone for so long. And, that's something that when we look at deals and we look at the viability of deals, we're always looking at the cash flow. Appreciation, the way I see it, is great, but it's future talk, right? It's like it may happen and it may not. So cash flow in my bank account today is what's real. And that's, how we always look at deals too. So I'm curious, when you're doing your underwriting for your current deals, or let's say like 5 months ago, you're doing your underwriting, what were you underwriting your year-over-year rent growth? For what were you projecting to? Was it,
we typically underwrite it to, right around 3%.
Okay.
It depends. So like we're also value add investors. So, in the mobile home park space, it's notorious for mom and pops not keeping up with what the market lot rents are in any given area. And so, typically we would look at, just give an example, if the market was $500 a month lot rent and we were buying a park that was at, $250 today currently, we might have the very first rent bump might be significantly higher than what the following years are, but we try to look at like a 5-year trend. How can we get to market in 5 years? We stretch it over a 5-year period. However, the one different factor of mobile home parks to that of apartments, the one insulation factor I like to call it, is that majority of the residents in these parks, they own their own home. And so there's like a shared equity involvement between the owners of the park and also the owners of the homes themselves. And so it's not as simple as like, well, I don't like the $40 rent increase, this first go around, and that you have a 5-year plan to basically raise it $200 over the next couple of years. They can't just simply move. They can, but there's a much larger, more expensive process involved with them moving their home and going somewhere else. And ultimately, if they did go somewhere else, they would be paying the market rent anyway. And so there's not really a good lateral move option for most of the residents and in the mobile home park space. So in any event, to answer your question, 3% is on a normal rent increase annual basis is 3% is what we underwrite.
And then what about vacancy? Or how does vacancy work in what you guys do?
Yeah,
you still underwrite?
Yeah, we do because you have situations where even if they own their own home, they could pass away. They still might lose their job, or they can't pay. They have to actually abandon that home or move it somewhere else or sell it. And so there is a vacancy factor there. And depending on the park, the market that it's in, anywhere between 2.5% to 5% is traditional.
And then how does these numbers that you were underwriting to, like, let's say 5 months ago, how does that look like now with everything that's going on?
That is the $1 million question. I don't know. The good thing is we were not in the middle of any deals when this occurred. And so the timing just kind of played out, I guess not right for us, but to where we're not having to kill deals, or we're not having to go back and retrade. We buy deals in fund structures, and we just wrapped up our last fund at the end of last year with the intent of rolling out another one Q2 of this year that more than likely will probably be delayed, just given the current state of affairs that we're in. And so as far as I don't know how to answer that question. I mean, until the dust settles a little bit, I don't think anyone can answer that question. In fact, I just had a phone call this morning with a gentleman that brought 3 off-market deals to us just to take a look at, and they're probably deals that we would have considered a few months back, or even a few years back, what have you. But today, based on their asking price, based on the cap rate, based on the available debt that we knew would have gotten put on back then versus today, like there's so many unknowns. I unless it's an absolute home run, we're not even going to consider buying anything until the dust settles a little bit and we see how all this shakes out. So I think there's going to be a lot of weaknesses exposed over the coming months and even the coming years for businesses that were on kind of already faulty foundations. And I want to be prepared to jump on those opportunities, but also I want to make sure that we don't become one of those victims that ultimately buy into a unstable environment, trying to catch a falling knife, what have you, and realize that it was the wrong decision. So we're basically hoarding cash. We're staying as liquid as possible. We've basically stopped a lot of our most of the CapEx or unnecessary projects in our communities, and just really kind of standing tight, on the sidelines, watching, waiting, and just seeing how ultimately these next couple of months, more importantly, are going to play out. How about you, ladies? I'd love to hear from your perspective. Not that I'm not going to try to shift this interview around, but I mean, you've had many of these conversations, as have I. Have you been underwriting deals still over the last couple of weeks? If so, what are some of the changes that you've seen, being that you're in a very different industry than we are in the multifamily space?
Yeah, I mean, we're still looking at deals, but we're in the position where we had deals under contract, so deals have fallen through. So we're in the position right now where one deal that we had underwritten in January is, obviously much different than now in terms of the opportunity and the deal, and, tried to renegotiate and do a retrade and didn't work out. So we had to back out of that deal, which, means that we lost some money, and it was a tough one for us to swallow. But we have another deal that's on the table that we're looking to also retrade. And we were able to renegotiate a better price on that one. But it's tough to raise right now. A lot of people are, either losing their jobs or unsure of what the future holds. And like you said, to your point, it's like, how do we even accurately underwrite unless the deal is a home run, which this one we feel like it is. It's really difficult to be able to pinpoint whether, what the underwriting is going to be like on a deal, and to be able to, identify the vacancy and identify, occupancy and all of these things. But this particular deal is a very good cash flowing deal. It's an A-class asset, so a little bit no value add, so a little bit different from what we've traditionally done. So in terms of risk, a lot lower. No value add, high cash flow. It's kind of a no brainer. Our break even point is in the 50% range. So things would have to get pretty dire before things would look bad on this one. So yeah, I mean, I'm the same. I'm ready to buy. This is the time that I've been waiting for. I got into real estate investing in 2009. And since then, I have been waiting for this time. But I think right now is too early to say what's going to happen and to really be able to identify the good opportunities. I think that those good opportunities are going to come, here in the coming months to a year.
Yeah, it's going to take time for that pain to really play out. And then ultimately also, depending on how the government might step in, there's the CMBS lenders and the banks that are holding debt right now, especially in some of the other industries, not multifamily, not mobile home parks, but retail and lodging, man, they're getting absolutely crushed. And so there will be a trickle down effect that ultimately that plays out if some of those other industries fail in a big way.
Right.
And it just, one of the things that we use as an indicator, you got the public sector, so the REITs, and then you got the private sector, which is us. And they're two different ways that the public and the private sectors look at investments. And you'll see that obviously a lot of the REITs, they lost a lot of valuation over the last couple of weeks. REITs are, for the most part, institutional investors are forward-looking. They're forward-looking. They're trying to project out based on discounted cash flow of like what things are going to look like in the coming years. Whereas private investors such as ourselves, we're looking at T12s, right? We're looking at the prior year's performance, hoping that that's going to indicate what the future performance is going to do for that property. And so, again, one of our considerations is that these institutional groups, not that they're smarter than us, but they've got pretty high pay grades on their staff and analysts and what have you. Just watching what they're doing and looking at the private sector and kind of taking the middle ground of the two and just kind of holding tight and waiting to see again. I don't know when the dust is going to settle. I don't think anyone knows. Again, that's part of the uncertainty. Every day, like there's some type of new, news release as far as like it's going to be extended another 2 weeks, or we're thinking this might run through summer now, or it might end before summer. Just so much uncertainty everywhere in the world that I know that deals will never be gone forever. Meaning like, that anxiety that some people feel of like, if I don't buy today, I'll never be able to get a deal. That same feeling was felt leading up to 2008. And the same feeling has been felt leading up to this point in time that we're sitting at today. The last 3 years, everyone's fighting for deals. Everyone's like razor thin margins.
Right.
And so I know that there will be opportunity coming. And I know that if we miss out on an opportunity, there will be the next one that comes down the road and, the next door will open, what happens. So just patience. That's kind of what I learned after leading up into 2008. And then thereafter is patience is where the most value is. Being a patient investor and just waiting and watching and making educated decisions and not jumping the gun on anything because knowing that there's going to be another opportunity coming down the road.
Yeah.
Yeah. I love that.
Yeah, I think a lot of the rest of the world, especially those investors who jumped on the bandwagon within the last couple of years, they're like, "Oh, I'm out. Like, I'm leaving. This is too hard for me." And the rest of us who have been in this for a lot longer, we're at the starting line with our carts empty. We're like ready to go. We're like, come on, where are those deals? Where are those deals? And I think you're right. Yeah. I think within the next several months, we're going to see a lot start to come on the market.
Yeah, I wasn't in a position in 2009, 10, and 11 for many reasons, just dealing with the carryover from the catastrophe that happened after 2008, but also just not sticking my head in the sand, but like it was like my world kind of ended for a period of time. My little bubble that I was in Florida in general, every investor I knew in Florida got just as crushed as I did, even folks that had been through a couple other downturns. And so I had a hard time getting myself out of that bubble and actually getting back up on the saddle and getting ready for the fight. And I promise I will not make that mistake this time around because we didn't buy that first property until 2012. And so we still had a good couple of years of phenomenal deals that were, kind of a leftover from the recession, but we missed a couple of the prime buying years, and I will not make that mistake again. I promise you that.
We'll get back to our conversation with Kevin in just a minute.
Have you been thinking about investing in real estate, but aren't sure you have the time or the desire to manage the investment? Perhaps you're afraid, like we were, that you'll make the mistake of choosing the wrong market or the wrong team and lose your entire investment. Well, that's exactly why we created the Goodegg Investor Club. We do the work of identifying solid real estate investment opportunities in the best markets around the country and then partner with you to acquire these investments, and then we'll all share in the returns. We'll identify the growing markets, strong, experienced teams, and the solid deals. We do all the heavy lifting of managing the tenants and the renovations, and as a passive partner, you get to enjoy all the benefits of investing in real estate: monthly cash flow, long-term appreciation, and the ongoing tax benefits. When we first discovered passive investing through real estate syndications, we realized it fit perfectly into our busy lives. We could put our money to work for our families, work less, and get more time back in our days so that we could focus on what matters most and discover our true passion and purpose in life. We've now helped hundreds of people invest passively in real estate syndications and are seeing the positive impact it's had on their lives. We invite you to partner with us by joining the Goodegg Investor Club today so you can start putting your money to work for you and get more time back in your day, because we know that when people have more time in their days, they can do the true work they were intended to do, and the world will be a better place. To sign up for the Goodegg Investor Club, go to goodegginvestments.com/invest and we'll take it from there. That's goodegginvestments.com/invest.
And now, back to our chat with Kevin Bupp.
When that happened, when you lost the 1,000 properties in your portfolio, why didn't you just throw in the towel? Why not just you're like, oh my gosh, I just lost everything.
Yeah.
Your family's probably like, see, told you. And so how come you didn't just walk away and say, I'm going to go lead a normal life and get a job and just go to work 9 to 5? What made you come back to it and keep wanting to learn and keep going in real estate?
Yeah, that's a great question. Well, number one, that was a normal life to me, because remember, I literally have never had a real job, I guess you could say. I attended bar and I started buying property. And so I never really had a 9 to 5. So that was normal to me, is actually starting a business and kind of making it for myself. But there was a couple of years. The 3 years following that were really tough emotionally. Thank God I did not have a family back then. Thank God I wasn't married. I didn't have kids to support. I was kind of on my own. I just actually had met the woman who is now my wife today. I literally met her about 3 weeks before I defaulted on a big chunk of properties.
And she married you anyway.
It's funny that you bring that up, because I just kind of knew. I'd been, looking and dating for a number of years, and I knew when I met her, but I was like, man, I'm not going to, when I met her, I had a house on the beach, had, vehicles, boat. I mean, I had a pretty cool lifestyle. And, I knew that was about to go away very quickly. I knew that it was going to get very, very ugly. And so I remember we were riding the bikes one day down at my beach house, and, we're riding our bikes, I forget where we're going, just cruise around the neighborhood. And, I wanted to let her know how bad it was about to get, because I didn't want to lead her down this path.
Right.
I knew she wasn't with me because of money. She had her own money. She had really good job and education. So it wasn't a money thing for her. I didn't think she was a gold digger or something. But I also didn't want her to, to get on a train that was basically going to derail.
Yeah.
In the very near future. And then I knew it was going to get, I didn't know how ugly it was going to get, but I knew it was going to be pretty ugly. And so I let her know. And I don't think she really understood the gravity of the situation. I don't think she really processed it. But ultimately she stuck by my side and was there for me. But as far as getting back into it and not just getting a normal 9 to 5, I will tell you that during those 3 years, I focused a lot on health and just being well. That's the only thing I really had control. I felt like I'd lost control over everything. I couldn't control anything else in my life other than how I felt, physically and mentally. And so I put a lot of emphasis there. And I started a few other businesses outside of real estate. I was so distraught and just had a bad taste in my mouth about real estate. And again, all my contacts and friends were Florida based, and they were in is just much distraught. So I never left that bubble for a period of time. All I felt was like the world had ended. And so what I wanted to do is focus on me. And I started a couple of businesses that were health and fitness related, that were completely opposite of real estate. I knew I needed to make money, and I wanted to have fun doing it. Not that I didn't have fun in real estate, but it surely wasn't fun when dealing with process servers knocking on your door and things like that, and lawsuits and what have you. And ultimately, the fire of real estate. 3 years of those other businesses, I had fun with them. They made money. I knew I wasn't going to turn them into something huge. I just didn't have an interest in doing that. I was just trying to survive at that point. But the fire burning of real estate was always there. The flame never really went out. And I don't know. I just woke up one day in 2011 and was like, I got to get back here and start buying some opportunities. Everyone knows the old adage of you buy low, sell high. You buy when there's blood in the streets. And I'm like, I'm an idiot. What am I doing here? Like, why am I sticking my head in the sand? Why am I trying to avoid what is now probably some of the greatest opportunities that have ever existed? Right. And so that's ultimately what I did. I jumped back in 2011, started re-educating myself as to this changed landscape that now existed, because the world was very different in 2011. In every aspect than what it was in 2008. And so it took me about a year to buy the first property after I made that decision. And I've been running ever since.
So I have a quick question before we transition into the Investing for Good Impact round. I know that it's always been said that mobile home parks are recession resistant. And again, given everything that's going on, why should investors turn to mobile home parks, in the years coming forward? Tell us a little bit real briefly about that.
Yeah, there's a lot of factors. I mean, simple supply and demand factors, are one of the really big ones that really sold me initially on mobile home parks. It's the only asset class that has a diminishing supply. And so there's not new supply coming onto the market. Any new supply that's coming on, it's not outpacing the parks that are being shut down or bought or redeveloped into something, of a higher and better use. And so the supply demand factor is huge. And it represents probably one of the best options for affordable housing in any market across the country. And I'm not talking like rundown trailer parks, that are basically the equivalent of like a D-class apartment building, right? Like there's all different classes of mobile home parks. And I think that's where the negative stereotype comes into, where people are like, oh, mobile home parks. You could say the same thing about apartment complexes, single family homes, right? You got A class, B class, C class, and you got the parts of town that you just don't go in. You got the slumlords that run really bad operations. We stay away from that stuff. And so, but just generally speaking, the C and B grade parks in any city across any state whatsoever, it represents probably the most affordable option for housing in that given marketplace. Our average lot rents across the board, anywhere from like the high markets up in like New York where we own stuff to, Kentucky and Alabama where it's on the lower end of the spectrum. Our average lot rent's about $350 a month. There is nowhere you can live in any one of those markets with a family in a nice, safe location with good schools, what have you, for that price. And so knowing that there weren't new supply coming in the market, knowing that we had an option that everyone was going to need forever. I mean, there's never going to be a point in time where someone doesn't want to live for, an affordable price point. And we know that there's not new affordable housing being built. Like we're not servicing that need in this country at this point in time, other than existing supply. And so that was one of the big factors that attracted me to it. And also, if someone in that park can't afford to live there, I know that there's many other folks out there. If we're in the right market, right school district, right location, there's a drove. I mean, we literally, even through this pandemic, we keep our postings going for available units that we have for sale, what have you. It literally hasn't slowed down. And not even a trickle, which is I was shocked. Yeah. Absolutely shocked that we just instilled protocols yesterday, because we literally stopped showings for 2 weeks until we figured out what's going on with this pandemic. Yeah. And I want to expose our managers to, to this health risk. And so we just instilled, protocols to where, they're wearing gloves and masks and, not meeting prospects directly in the units. We're doing virtual showings, what have you, because the demand hasn't gone down. And so that's a huge factor for us. Good times, bad times, demand is always there because everyone needs a nice, clean, safe, affordable house to live in a great location, right? Good school districts. In addition to that there's this insulation factor that, that I had kind of mentioned, in one of our, past conversations here today, is most of the residents own their own home. And so the turnover rate is not the same as that in like an apartment complex. And so now I don't want to mislead the listeners. We do own some of the homes. So we have about 2,000 lots in our portfolio, and we own about 200 and give or take 50 homes, not by choice. It's just part of the business. But the remaining folks own their own homes, and it's incredibly expensive to move those homes. So what we have found is that our average length of tenancy is 12 years. Oh. And so it's very similar to that of a single family home neighborhood. In fact, what happens is if that person needs to move, let's say they get job transfer or whatever, they just need to move out of that area. Most of the time they don't move their home because it's too expensive. And so they typically put it up for sale, just like you would a single family home, put it up for sale, either with a realtor themselves. They continue paying lot rent. They show their home. Someone comes in and buys it. That new person gets approved for the community. They take over the responsibility of paying lot rent. And so even though we actually lost a tenant, we never had a hiccup in the revenue coming in, the monthly lot rent coming in. So, those are some of the big factors. One of the other big ones that really attracted us to the space and still does today. So it's changing landscape today. Lots of private equity and institutional investors have come into this niche over the past 2 years in droves. And there's limited supply. And so it's created a lot of competition. But even then, it's still a very fragmented marketplace. Lots of mom and pop operators, lots of first generational owners that built these things 40, 50 years ago that are aging out of them. They're in their 80s now. They haven't done a great job of running the communities as a professional operator. They haven't kept up with market rents. They haven't, kept up with mitigating or keeping expenses to a normalized level, what have you. And so there's still a lot of value add opportunity that exists in the space due to the fragmentation of the ownership. And so those are some of the big ones that really attracted us to the space. I could keep going on and on for another, probably 30 minutes of all the reasons we love it, but those are some of the big ones.
Cool. Thank you for sharing that. And do you have information about all of this, I would assume, on your website? I'm just curious if people want to learn more about mobile home park investing and, all of these things that we could talk more about. Is there information on your website about all of this?
Yeah, absolutely. So our company website is sunrisecapitalinvestors.com. You can go in there and get a ton of information about the industry in general.
Okay.
And I also have a mobile home park investing podcast where we've got probably 110, 115 episodes.
Okay.
They can go there. It's all free. And basically, it's a lot of that podcast has been over the last 4 or 5 years, case studies of our business, deals that we've done, why we passed on something, why we purchased something, how we've analyzed markets, what we view as an opportunity, not as an opportunity, what have you. Just we go into the nitty gritty details of the business. And so I would start there as well. It's free. There's hundreds of hours of education there.
Mm-hmm.
So that'd be where I would get started. If I were starting again 7 or 8 years ago and all that stuff wasn't available, that's where I'd get my start.
I got one more question for you, which is you mentioned earlier that you do funds rather than have your investors invest directly in a single mobile home park. Can you talk about why that might be a particularly good strategy at this point in the market cycle?
Yeah, I don't know if it really has to do with a good strategy based on the part of the market cycle that we're in. But I can tell you the reasons behind why we ended up going that route. I guess it's been about 4 years now. When we started syndicating, we had the initial intentions of just doing deal-specific syndications. And now I want to preface it by saying that our average deal size is much smaller than that in the multifamily space. Like our average deal size, back then it was probably like 1 to 3 million. Now it's probably like 3 to 5 million, but still very small in comparison to what you guys are used to in the multifamily sector. And so leading up to the point where before we started syndicating, we were doing our own deals. We basically we went a number of years, proved the concept, built our business, built the infrastructure before we ever started raising capital from outside investors. Mm-hmm. And we were really good with deal flow. That's one of the things I kind of carried over from my single family days, going direct to owner and just building that stream of deals that were off market, that weren't relying on brokers or folks bringing them to us. And so we were very confident in our deal flow. We had done a great job leading up to the point of syndication, and we had a couple of deals in the pipeline right before we started our first fund. A couple of those deals fell out, and then we had like 2 left. I'm like, okay, well, we're just going to syndicate these individually. Doesn't make sense to do anything else. However, the next 30 days, we had 3 deals come back alive. And all of a sudden, we found ourselves in a situation where we had 5 deals in contract. And we started looking at the logistics of actually, doing 5 individual deal raises, the costs associated with the legal of doing 5 individual. I'm like, that makes no sense whatsoever. And so let's give our investors some diversity. These are in 3 different markets, these 5 different deals. They all have, different components to them that are attractive in nature and will help diversify the risk as well. And so that was the initial thought behind why do a fund. And as we got into that fund and then ultimately open up a second larger fund, we realized that there were some other big benefits other than diversity for our investors and also logistically and keeping legal expenses down is the buying power. And so I'll give you an example. Last year, we just closed out our second fund at the end of last year, 2019. And there are a couple of deals, it's a tight landscape. I mean, everyone's, fighting for deals. And there's a couple of deals that came our way last year that we probably would have missed out on if we didn't have the ability to actually be a cash buyer. And so one of those deals was a 30-day DD close period total. And there was 3 deals in a portfolio. that was challenging in and of itself. There was a lot of other interested parties there. The only reason that we became the selected buyer is that we literally paid cash for that deal. We knew we wouldn't be able to get the financing lined up in time. We started the financing process, but we knew that it would probably trail another 30 days behind when we actually closed. And so we had another deal just like that as well, that same, the same year. So we bought 4 deals that we probably wouldn't have been a real buyer for. We had gotten passed on. But being that we could actually close cash and we had liquidity to do that, made us, the selected party. And so the buying power behind it is huge. And so, just some of the benefits that we see. Again, our niche is very different to yours. One of the downsides that I tell everyone thinks, fun, I can just go raise a bunch of money and, have all this money sitting around, to have buying power. It doesn't really work that way. I mean, typically if you got the money in, it's accruing pref. If you've got your structure that way, it becomes very expensive money. And so you got to be very confident in your deal flow. I mean, like if you're not a person that has steady deal traffic coming in, you're continually raising capital, then you're going to get yourself in a pickle to where you're not going to have deals coming in. You've got accrued capital and accrued pref building up, and ultimately just closing your gap of any type of reward that you're going to get on the back end, being the GP or the sponsor of the deal. So there's pros, there's cons with it. I don't think one way is better than the other. It's really what works best for our firm and what works best for this deal and our investor base. That's really it.
Makes sense. Makes sense.
All right. Should we move into the last part of the show?
Let's do it.
We're going to ask you a couple of questions around investing for good. So the first question is around investing in yourself. So what is one way that your investments are helping you to live a better life?
Yeah, that's a great question. I've always been a fan of flexibility and in terms of the type of business I'm in, and also how we try to empower our employees, and my partner that I have, like we all kind of have the same mindset of we're all performance based, meaning that like we don't work in an office 9 to 5 structure. We actually had an office up to like 2 months ago, but we don't have like a structured environment to where you're there 9 to 5 Monday through Friday, get your work done. Like everyone knows what the expectations are, get it done. And so that type of flexibility and mindset has allowed me to do what I enjoy doing the most, which is actually spending time with my family. I love, we travel a ton as a family. We spend a lot of time here in Florida, out in our boat, just doing mini trips, going out of the country. I mean, anyway, it gives me the opportunity to be devoted as a father, as a husband, and, take advantage of those special moments and create those special memories. That I'd say one of the biggest regrets I've heard over the years of folks that have always been like older mentors of mine is that they missed out on those special years and they structured their business the wrong way. They might have done really well. They completely missed what was most valuable, and that was that family time. And so I vowed many, even David was a victim of it. I saw it with him. I hope he doesn't listen to this, but his relationship with his son wasn't great, and it's still not today. He never figured that out. And that was sad for me to watch. So anyway, that's one of the things that this business and this, real estate in general has allowed for me.
Yeah, I love that. And there's so much of the reason why I got into what we do is, for many of the same reasons, just not wanting to miss out on, that time with the kiddos. And, right now being able to still work and do what we do and be home with my kids is great. So I love that. Okay.
Challenging too. My wife has the same. Yeah. She's been managing, the 3-year-old. Normally they're at school, right? Normally they're like, school during the day. And, but yeah, so she's been a saint. So honey, if you're listening, I love you.
Yeah. It's been the last 3.5 weeks have been interesting. I've now know how to cut hair. I am now a teacher. I'm now a cook on the weekends, and it's all, holding all these different roles. It's been
I have to watch some YouTube videos on the hair thing, because I feel like in the next 3 weeks, I'm going to have some issues. I'm not quite sure how to address them.
Yeah. See, we were already behind before all this started. So it was like, we got to do something about this. So I threw on a YouTube video and went on it. All right. Investing in others. So what is one investment strategy or hack that you might be able to share with our investors, especially right now with everything we have going on with COVID-19, that they might be able to use to leverage all of this potential opportunity that we've been talking about over this episode?
Yeah, no, that's a great question. And I think there's many different answers I could give. And so, I think that the angle I'll take there is, I know that we're all busy still. if you have a business and you're still busy, right? If you have rental properties, you're still busy maintaining the day-to-day. But like, this has forced us all to really take a deep look at our daily structure, and where we're wasting time and how to spend it more efficiently. And I think that a lot of people are realizing that they actually have a lot of downtime that they might not have realized before, especially if they're going to an office or commuting or what have you. And so I think just to leverage that time, at some point it's going to be gone. We're going to go back to whatever the new norm is. It's not going to be how it was, 2 months ago, but it'll be the new norm. But things will get back to some type of normalcy. And that time that you found as your downtime or free time will probably no longer be there, or will be filled with something else. And so take advantage of that time, dive into, books and podcasts. I mean, if it's, if you want to learn a new craft, if there's another asset class that you've had an interest in for a long time, study it, study historics on it and compare it to what's happening today, and just educate yourself so that you can, again, we talked about taking advantage of potential. I hate the word advantage. There's got to be a better word for that, because I don't like taking advantage of anybody, but being prepared for the opportunities that present themselves. How can you prepare today so that you're prepared 3 months, 6 months, a year from now when, those opportunities start coming available. So that's what I just see so many people on Facebook of like, oh, we're doing a happy hour again today at 4:00. It's like Monday. And it's like, okay, that's cool for a little bit. But like, if you're doing that every day and you're like drinking every day and you're not like paying attention, I mean, what's it all for, man? Like focus on you at this point, because this is a forced opportunity for us all to do that and have some self-reflection.
Yeah. Yeah, that's such a good tip. It's one that I've been preaching for the last couple of weeks. It's like, this is, at some point, this is going to end. And the people who have been preparing for the end are the ones who are going to thrive in whatever the new normal is. And the ones that were out, sitting around and, worrying about everything and not doing anything are the ones who are going to, one day when this is all over, be like, oh, shoot, like all this time I should have been preparing, now what? So I think that is an important thing for folks to remember.
And stop watching the news. I was actually a victim to this up until 3 weeks ago. And I'm like, and I got news apps. So I was like, what? Every morning for 5 minutes, I'm just going to review whatever the top news was for the prior day. And that's it. Because I was like, I'm not one to be glued to the TV. Because I've been following this thing since, which is weird. I never pay attention to this kind of stuff. I don't remember SARS. I don't remember like any of that stuff.
Me too.
But this, in like January, like right after like New Year's, I'm like, for whatever reason, I think this is going to ultimately have a worldwide impact, and I don't know how. And I remember we were on a ski trip in February, and I'm talking to the whole group. It was like 16 of us there, and I'm like talking to people, a lot of other business owners, and they're like looking at me like I'm crazy, and I'm like, how can this not have a major impact if they shut down like they did in China? What they're doing in China? Really here, like how's that ultimately going to affect every single one of us in this room? And,
totally.
Anyway. So I found myself glued to the TV, and I stopped that like 3 weeks ago. And now I just 10 minutes every morning, whatever it takes me to read the latest updates of the prior day. And that's it. I don't even look at it after that. I figure I'll find out. Someone else will tell me if something big goes on that same day, right? I'll find out one way or another. Yeah, I had to put the same limitations on myself too, because up until a couple of weeks ago, I was like every minute of the day just checking what's new, because stuff is changing so quickly. But then I realized, it's going to continue to change, and so that's what I did. In the morning, I take in my first 5 minutes, see what the news is, and then that's it. And then I get it again the next morning, so that you don't get overwhelmed. Okay, so last question is investing in the world. So what is one way that your investments are helping to make the world a better place? Yeah, so it's probably in an indirect way. About 10 years ago, I started a charity event. It was literally after the crash. It was a way I didn't have any money after the crash happened, so it was my way of actually taking a hobby I really enjoy, which is cycling, and turn it into a way to give back to some of the favorite charities that I've supported over many years prior. And that event is still going strong each and every year. It's every November we do a 3-day bike ride, 75 people from across the country. We raise money for 2 charities that are near and dear to my heart, and essentially, ride our bicycles from Fort Myers Beach all the way down to Key West. It's called 72 Hours to Key West, and all that money goes to these 2 specific charities. But I think, reeling it all back in, my lifestyle, like our business allows me to do that. And it's also garnered a ton of support from other folks that aren't the cyclists, just outside businesses that we've come in contact with, title companies, attorneys that we worked with that have, really come to support this cause, these 2 causes that this ride supports. And so again, I don't know, the event takes a lot of time and energy. I don't think that if I had a normal job where I only had like 2 weeks of vacation a year, 3 weeks, I don't think I'd have the time or energy to manage it or put together each and every year, or to support the team that we have that helps pull it off every year. So that's one of the few ways, but I think that's a big one, because we've donated. I think now we're nearing $500,000.
Wow.
Most of it being over the past 7 years. The first 3 years were a little bit of a slow chug to get the thing going, but now each and every year we, on average, donate anywhere between like $50,000 and $60,000, and it makes a huge impact to the local area here.
Yeah, of course. That's incredible. And it's something that we talk about all the time, is that money and flexibility don't change who you are. They amplify who you are. And you can tell through all the things that you are doing that, your lifestyle has really amplified the values that are important to you. So, Kevin, I know we've talked about a couple places people can go, but where do you think people should start with all the resources that you've got out there? What's the best place that they can go to learn more about you and all that you're up to?
Yeah, no, my home base is kind of my personal website. It's kevinbupp.com. And you can go there and you can get links to our company website and our mobile home park podcast. And then I have another commercial real estate investing podcast that I do on a weekly basis. And you can listen to that there on my main website. It's called Real Estate Investing for Cash Flow, but it's a commercial-based investment podcast. And so that's the home base, kevinbupp.com. If you want to contact me, just go to the Contact Us page and drop me a line, and you'll hear back from me within typically like 24 hours or so.
All right. Well, we'll have links to kevinbupp.com as well as the other resources that you mentioned in the show notes. Kevin Bupp, creator of Mobile Home Academy, host of the Real Estate Investing for Cash Flow podcast, founder of Sunrise Capital Investors, and the list goes on and on. Thank you so much for being here with us, Kevin.
Thank you, Annie and Julie. It's been a pleasure.
Thanks, Kevin.
You've been listening to Investing for Good, the #1 podcast for people like you who are investing to build a legacy for their families, create a meaningful and intentional life by design, and impact the world around them. For more resources, check out goodegginvestments.com/podcast, and be sure to join the Investing for Good Facebook community. And don't forget to subscribe and give us a 5-star review so we can continue to bring you amazing new conversations every week. Until next time, keep investing for good.